Oh, well, welcome to Chapter 18, where we start to talk about capital investments. And this will be our last chapter of this course. In this chapter, we talk about capital budgeting, the various inputs, and how to apply the payback technique. So looking at the value of our capital and how long it'll take to earn the spent funds on that capital back from the production that the capital item creates. We'll look at the net present value method. We'll look at some possible capital budgeting challenges and how you can make it better. We'll look at the internal rate of return method and the annual rate of return method. So we'll explain what those mean today. So the first item is talking about just what is capital budgeting, and we'll look at the cash payback process. So typically, corporate capital budget authorization processes includes, requisitions or requests from various departments or personnel management team that says, hey, I need a new machine, a new robot, a new vendor, a new whatever it might be. These proposals are typically reviewed by some kind of committee at the organization, so it's not always up to a single point of contact. But typically, there's a capital budget committee that will review those proposals. That committee would make recommendations up to some level of officer with authority to make decisions, and they would make decisions as far as what projects are worthwhile investing in. And then in most organizations, you have a board of directors that approves the capital budget. So just like we talked about at the beginning of this course about operating budgets, there is a capital budget component as well that typically a board of directors would be responsible to approve. For purposes of capital budgeting, though, we look at estimated cash inflows and outflows as the various inputs required. So how much cash are you going to spend on acquiring the asset, to carry the asset, to maintain the asset, versus how much cash can that asset generate? So how much production can it make? What kind of capacity is it going to create for the organization? And at the end, the value of all of those financial investments are determined by the value of those cash flows received versus paid. So some of the typical cash outflows, you have the initial investment, you'll have mentioned maintenance costs, possibly increased operating costs compared to the current asset. You might have some overhaul of equipment, so otherwise, renovation, a major repair, maybe you replace, a major item, a motor or something like that. Inflows, sometimes you'll have the sale of the old equipment that's being replaced. Maybe you're increasing your sales ability, so you have cash receipts from customers. Maybe you're reducing your operating costs compared to the current machine. And what is the salvage value of the equipment that you're considering purchasing? So those are all considered inflows for cash flow reporting related to capital budgeting. Items that affect capital budgeting decisions, what kind of funds are available in the organization? What kind of limitations are in place for the organization to decide whether to invest or not? What are the relationships amongst the various projects? So how does this investment support other investments or other activities? Typically, organizations have some kind of decision-making approach. So does it meet X, A, B, C? What are the various criteria? Does it help move you towards a strategic goal or a significant objective that you have as an organization? And then also, what's the risk associated with a particular project? So what if you buy this item? It's a 10-year investment. What if sales don't happen? What if new technology comes out? What if, et cetera? So what are the risks associated with that project? So a little example here, we have Stewart Shipping Company. They're considering an investment in $130,000 of new equipment. It has an estimated useful life of 10 years, no salvage value. We think we'll bring in cash inflows of $200,000 per year from customers. So we're making something new. This is incremental. And the cash outflows, so the operating costs of that machine are about $176,000 per year. So the net annual cash flow is expected to be $24,000. So just a straight, simple process. This is considered the cash payback technique, so not the value of money, which we'll talk about later in this chapter. You would simply take the cost of the capital investment, $130,000, divided by the net annual cash flow in this example of $24,000, which means the cash payback period would be almost 5.5 years. This does not look at the time value of money. Keep that in mind. The cash payback technique is just one number divided by the other. And the shorter payback period is the more attractive investment. So if you're weighing a number of options and you have cash payback periods of say 2, 3, 4, 5, 10, 20, 30 years, typically the shorter periods are more attractive, typically. Sometimes you have uneven cash flows though. So in the case of an uneven net annual cash flow, the company needs to determine the cash payback period when the cumulative net cash flow equals the cost of investment. So you're set up your schedule a little different. In this example on screen then, we look at the original investment of $300,000 and we have the net annual cash flows. So we have 60, 90, 90, 120, 100 over years 1 to 5. Our cumulative net cash flow, then we would add up over time. Again, this is not looking at time value of money. So the $300,000 investment would be received somewhere between 3 and 4 years. We're saying 3.5 just for demonstration purposes. So when your net annual cash flows are not even every year, you need to determine the cumulative net cash flow each year. Little question then, a $100,000 investment, no scrap value, has an 8-year life. Compute the payback period if straight line depreciation is used and net income is determined to be $20,000. So in this example, if we're told our net income is $20,000, we have straight line depreciation that is included in there. So the original asset of $100,000, straight line over 8 years, would be amortization of $12,500 per year. So our net income before amortization then would be $32,500. Take the $100,000 initial investment divided by the net income generated before amortization of $32,500. You'll get the answer is 3.08 years. So in 3 years, you would have generated $100,000 in income before amortization. A little example again, we have Watertown Paper Corporation. They're looking at adding another machine to manufacture corrugated cardboard. The machine would cost $900,000. It'd have an estimated useful life of 6 years, no salvage value. We think the annual cash inflows would go up by $400,000. However, our cash outflows would increase by $190,000. So our net annual cash flow will be $210,000. Computing the cash payback period, we take the $900,000 original outlay divided by the $210,000 net annual cash flow generated would be 4.3 years to have the item paid for from a cash payback perspective. All right, let's move on to the net present value method. So net present value is typically recognized as the best approach because we know the time value of money. Over time, if you earn $1 today versus $1 in the future, or pay $1 today versus $1 in the future, those dollars are not the same. Cost of living, continues to increase. Inflation affects those items. So this is typically recognized as the best approach. So in this example, or in this method, the net present value method, it looks at both estimated total cash inflows and the time value of money. So there are two methods. There's the net present value and there's the internal rate of return method. And the net present value method, we look at the cash flows that are discounted to the present value and then compared with the capital outlay required by the investment. The interest rate used in discounting future funds are determined by the company's discount rate or the required rate of return. The proposal is acceptable typically when the net present value is either 0 or positive. So as long as you're not losing value by investing in this asset, you would typically invest. And the higher the positive net present value, the more attractive the investment. And obviously, if it's negative, you would typically not accept it. So if we look at a little visual here, we have the present value of the net cash flows less the capital investment equals the net present value. If it's 0 or positive, accept. If it's negative, reject. Little decision tree. Let's put a little presentation here. In Stewart Shipping Company example, the company's net annual cash flows were $24,000. If we assume this amount is uniform over the asset's useful life, which means it's equal per year, we can compute the present value of the net annual cash flows. So we look at the present value at 12% for 10 years. If we use our discount factor sheet, or if you have a financial calculator, or you can use Excel, you'll get the factor of 5.65. So you take the 24,000 times the present value factor of 5.65 will give us a present value of the future cash flows of 135,605. Then what you do is you calculate the net present value. So the present value of the net cash flows, 135,605, plus the capital investment of 130,000. So we have a positive net present value of 5,605. So this proposed capital expenditure would be acceptable, financially at least, at the required rate of return of 12% because the NPV, net present value, is positive. Now, if it doesn't fit their decision matrix, their strategy, or something has a higher net present value, they might choose something else over it. Keep going through an illustration. Stewart Shipping Company expects the same total net cash flows of $240,000 over the life of the investment. But because of declining market demand for the new product, the net annual cash flows are higher in the early and later in the later years. Present value is calculated as follows. So now you have to discount each year separately. So using our present value of a single payment in the future, so a single payment of $34,000 1 year out at 12%, would be discounted at 0.89. So you can use your tables, financial calculator, or Excel, and you would do each item accordingly. So a single payment of $18,000 10 years from now would be discounted by 0.32, or multiplied by 0.32 to get the net present value. So the value of the $240,000 10-year cash flow would actually be worth $144,367. In this case, we have a higher net present value because we're earning more of the future cash flow earlier within the 10-year period. And it would still be acceptable. Many companies use what they call a required rate of return equal to its cost of capital. That means the rate that it must pay to obtain funds from creditors or stockholders. So the discount rate typically has two elements: the cost of the capital and the risk. The rate can also be known as the required rate of return, the hurdle rate, or the cutoff rate. So what they would expect at what point, if your net present values were negative, you would not invest because you could do something better elsewhere. It's not worth the risk or the cost of capital. So Stewart Shipping used a discount rate of 12% in the previous examples. What if this rate did not take into account the risk of the project? So management decides that a more appropriate rate might be 15%. So we go through the same process, doing the present value, 12% and 15%. So remember, at 12%, we had a positive NPV. But at 15%, you can see on the right-hand side of the screen has a negative net present value of $9,550 because we're discounting at a higher rate of interest. And that's to take into account the additional risk of this investment. So in this situation, you probably would not invest because it doesn't meet the rate of risk required for positive acceptance. Typically, you make some simple assumptions. All cash flows come at the end of each year. All cash flows are immediately reinvested into another project that is a similar rate of return. And your cash flows can be predicted with some level of certainty. So you have to make some assumptions when you're valuing your capital projects. So a little review question. Compute the net present value of a $260,000 investment with a 10-year life, annual cash flows of $50,000, and a discount rate of 12%. So you'd look up in your present value tables, 12%, 10 years. You have your multiplication factor, which I don't have written down. But at the end of the day, you should have a positive net present value of 22,511, which means if you invested 260, that means your future cash flows would be worth 282,511. Again, you can use Excel or financial calculator or your present value tables. Remember, this is equal 50,000 per year for 10 years, 12%. Another comprehensive example we're going to walk through here. Best Taste Foods is considering investing in new equipment to produce fat-free snack foods. Their initial investment's $1 million. Cost of equipment in 5 years to fix it will be $200,000. The salvage value of the equipment after 10 years will be $20,000. The discount rate is 15%. Annual cash flows is $500,000 inflow from sales, $200,000 for cost of goods sold, $30,000 for maintenance, and $40,000 for other direct operating costs. So first of all, we need to compute our net annual cash flows. So this is annual estimated cash flows here. So we take the 500 less the 200, 30, and 40. So we have a total net annual cash flow of $230,000. So now let's do our little computation of net present value. So our net annual cash flow of $230,000 over 10 years has a discount of 5.01 factor applied. So the present value would be $1.154 million. The salvage value is a lump sum, one payment of $20,000 at year 10 at 15%. It's a multiplication factor of 0.24719. We'll subtract the original purchase and the equipment overhaul, which because it's in year 5, it's also discounted to $200,000 at year 5 as a single payment. So our net present value then would be positive in this situation of $59,825. All right, let's look at a net present value of Watertown Paper Corporation. They're looking at adding another machine for the manufacture of corrugated cardboard. The machine would cost $900, estimated life is 6 years, no salvage. The company estimates that annual cash inflows would increase by $400,000, annual outflows would increase by $190, and the required rate of return is 9%. Our net annual cash flow then, it would be $400 less than $190 is $210. The present value of the annual net cash flows would be $942, capital investment $900 because it's today. So our net present value would be positive again at $42,043. All right, next section is let's look at capital budgeting challenges and changes that you might make to your processes. So sometimes, we always calculate net present value. We ignore intangible benefits. So if the net present value is negative, sometimes you want to ask yourself, are there other benefits that's worth at least some value of negative? So you might not have looked at the impact on other projects, maybe impact on morale of your employees because it's newer equipment versus what they're using, et cetera. So sometimes you need to consider other, what we call intangible benefits. Sometimes an organization will project conservative estimates of the value of those intangible benefits, and they'll incorporate them into the net present value calculation. So for example, we're considering the purchase of a new mechanical robot, cost $200,000, inflows $50, outflows $20, 10 years, discounted 12%. So our $30,000 annual cash flow, 10 years, 12%, $169, initial investment $200. So we have a net present value loss of $30,493. So right away you think, oh, this isn't acceptable. But you know what? This company, we want to look at intangible benefits before we decide whether to reject or not. So we think that, you know what, we might improve sales by $10,000 annually because of perceived quality, because we have better machinery, more reliable, maybe better quality. They also estimate that annual cost outflows would be reduced by $5,000 as a result of lower warranty claims, reduced injuries, and fewer sick days. Using those factors, should we accept? So now our cash outflows change. Our net annual cash flow changes. And our present value is now positive at $54,260. So basically what you're doing is adding the $10,000 per year additional revenue, and you are reducing your outflows by $5,000. So our positive net present value in this case, so they would accept it. All right, sometimes you look at a profitability index for mutually exclusive projects. So sometimes proposals are, you can do one and not another, or you do another one and not that one. They don't rely upon each other. So often managers have to choose between various positive net present value projects because of limited resources. So sometimes organizations might say, okay, whichever one has the highest net present value, let's choose it. But it's not always the right decision. So let's look at an example. Two mutually exclusive projects, each with a 10-year life and a 12% discount rate. We have two slightly different net present values of $18,000 and $20,000 for Project A and Project B, respectively, all discounted to today. One method of comparing the alternative projects is the profitability index. So we look at the two projects, what's the present value of the net cash flows? So let's move back again, 58 and 110. Less the initial investment equals the net present value. So that's a little summary from the previous chart. And the profitability index looks at the present value of the net cash flows divided by the initial investment. So what's basically a rate of return? It's, in this case, we call the profitability index. So Project A has an index higher than Project B. So even though it has a lower net present value, compared to the initial investment, it's a better investment. Okay, let's do a little review question. Assume Project A has a present value of net cash inflows of 79.6. Initial investment of 60. Project B has a present value of cash inflows of 82.5. Initial investment of 75. Assuming they're mutually exclusive, which project should management select? So Project A, you have 79.6 less 60 is 19.6. And the other one's 82.5 less 75 is 7,500. So you would assume Project A, because they're mutually exclusive. And that's without looking at the profitability index. Now, if you look at the initial investment of 60 with a return of 19.6, it's about a third, versus the second project had 7,500 out of 75,000 investment. It's about a 10%. So that in either case, Project A is better. Risk analysis. So sometimes many analysts on the finance side also look at what do you know? What do you have certainty about? So we know projected results are only estimates, but sometimes a sensitivity analysis will help to deal with that uncertainty. We use a number of outcome estimates to get a sense of variability. So we might look at what if our expected rate of return changes? What if our sales volume changes 10,000 up or down? So those are considered sensitivity analysis. How does it change our results? Another item that we typically do is what's called a post-audit. So often, if managers make estimates at the beginning to help us determine whether we want to invest in a project or not, if they know we'll be looking after the fact to see how close they are, and we'll use that to decide in future projects that they submit, hopefully they submit reasonable and accurate data when they submit the proposals. It also looks or creates an opportunity where we could stop investing in their project because they're not meeting certain targets. And if we consistently don't meet or we consistently exceed our expectations, then we can change some of our assumptions for future project proposals. Taz Corporation has decided to invest in renewable energy sources. It is considering solar versus wind. After considering cost savings as well as the incremental revenues, the power grid, they have the following: present value of annual cash flows, initial investment. So what's the NPV, profitability index of each project? Which energy source should it choose? So we take the 78 less the 45. So on the NPV basis, wind wins. The profitability, NPV divided by the initial investment, solar beats wind. So the investment in wind power generates a higher NPV, but it needs a lot more money up front. But the profitability index favors solar, which suggests that the additional NPV of wind is outweighed by the cost of the initial investment. So in this case, the company should choose solar power. Moving on to the internal rate of return method. So this differs slightly in that it finds the interest yield of a potential investment. So internal rate of return is the interest rate that will cause the present value of the proposed capital expenditure to equal the present value of expected net annual cash flows. Let's walk through an example. Stewart Shipping Company is considering the purchase of a new front end loader, costs almost $250,000. Net annual cash flows from this loader are estimated to be $100,000 for 3 years. To determine the internal rate of return on this front end loader, the company finds a discount rate that results in a net present value of 0. So we're just going to pick 10, 11, and 12 for this example. And we take the net annual cash flows, 100, 100, 100, discount based on the different discount factors. And you can see at 11%, it's basically a net present value of 0, where if your discount factor was 10, you'd have to be positive, discount factor 12, you'd be a loss. An easier way to approach this is when the net annual cash flows are equal. So if they are equal year after year, what we can do is take our capital investment divided by our net annual cash flow, and that determines our internal rate of return factor, which then we can look up in our present value of an annuity table, find the factor on the table. That'll tell us the interest rate based on the number of payments. So we know that this is a 3 years. So we look at where n is 3 and look across at the percentages until we get to a factor that matches this calculation. So one nice thing is if they're equal net annual cash flows. Just a little decision criteria. Internal rate of return, we compare it to the required rate of return. So in this example, we had 11%. If our required rate of return was 10, great, let's invest. If our required rate of return was 15, we better not. So let's do a little comparison of the discounted cash flow methods. The objective of net present value is to compute an NPV versus the internal rate of return computes the internal rate of return. So it's a percentage versus a dollar amount. The decision rule is if the NPV is 0 or positive, you would accept. Otherwise, reject. If the internal rate of return is equal or greater than the required, you would accept. Otherwise, you would reject. So similar outputs, 2 different ways of looking at it. All right, Watertown Paper Corporation is considering adding another machine. For the corrugated cardboard. The machine would cost $900. Estimated life is 6 years, no salvage. Annual cash inflows of $400, outflows of $190. Required rate of return of 9. Let's calculate the internal rate of return on this project and discuss whether it should be accepted or not. So because it's equal annual net cash inflows, 400 less than 190, we can actually just look up in the table based on the investment divided by the net annual cash flow. So 400 less 190 is 210. 900 investment divided by the 210 is 4.28. So let's look at the present value table. So we know it's 6 years, and we scroll across till we get 4.28, and it's somewhere between 10 and 11%. Closer to 11, it looks like. And the required rate of return was 9, and we're greater than 10, somewhere between 10 and 11. We should accept it. All right, last objective for this lesson is using the annual rate of return method. So this indicates the profitability of a capital expenditure by dividing expected annual net income by the average investment. Gives our annual rate of return. So an example again, Renault Company is considering an investment of $130,000 in new equipment. The equipment is expected to last 5 years and have salvage value at the end of its useful life. Zero salvage value, and they use straight line depreciation. So sales of 200,000, manufacturing costs exclusive depreciation 132, depreciation expense 130 divided by the 5 years 26,000, selling admin 22,000. Sorry, income before income taxes is 20, and we'll assume a 35% tax rate. So we have a net income of 13,000. So here we are. What's our original investment plus the value of the end of useful life divided by 2 equals the average investment. So 130 divided by 2 is 65. So our expected annual rate of return, 13,000 divided by 65,000 is 20%. And this project would then be acceptable if this rate of return is greater than the required rate of return. 20% seems pretty good. Another example, Water Paper Corporation. Again, the corrugated cardboard machine, 900,000, 6 years, no salvage, 400 if income, not 190 expense, straight line, and a required rate of return is 9. So we look at revenues, plus expenses, plus depreciation, 340, annual net income of 60, average investment, 450, 900 divided by 2, no salvage. Annual rate of return, 60 divided by 450 is 13.3%. If our required rate of return was only 9%, we would accept this proposal. So again, that's different ways to evaluate whether we're investing in capital projects or not. And I hope this helps. Take care.